Alphabet stock is up 69% year to date in 2025. And of course, I'm happy about that. I've had the stock rated as a buy all year. In fact, for most of the year, up until about 3 weeks ago, I had Alphabet rated as one of the best stocks to buy this year. And I've owned Alphabet stock in my own portfolio since 2020. So I'm happy for several reasons about the performance of Alphabet stock so far in 2025. But now let's look ahead to 2026. And is the stock still a buy? Is it still an opportunity for investors in 26? That's the question I'll answer in this video, evaluating Alphabet stock, looking back longer term, and looking forward and calculating a fair value for this stock using my proprietary DCF to come to a conclusion whether I think this stock is a buy, hold, or sell going into 2026. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So one of the reasons why Alphabet has performed so well in recent years is because of the company's excellent revenue growth, which increased from 75 billion in 2015 all the way up to 386 billion in the most recent trailing 12-month period. That's good for a compounded annual growth rate of 18.3% in that time. Now, looking forward over the next decade, I don't expect the company will generate revenue growth at this compounded annual rate, but I do believe the company will generate revenue growth in the double digits for the next decade, and that would be an excellent revenue growth driver for the company, given that it will drive that kind of growth on a much larger scale, starting with 386 billion. The primary driver of that increase will be the company's investments in artificial intelligence and the data centers optimized for AI, which will increase its capacity for delivering cloud services to its partners that are looking for those computing capacities, as well as the company's advertising business, which continues to thrive, and the advertising industry will grow overall at roughly double digits for the next decade. And then the digital side of the advertising industry will likely grow at a faster rate than the overall advertising market as more advertisers look to digital areas for investment away from traditional and legacy methods for investment. For all of those drivers will increase Alphabet's revenue over the next decade. The next thing I wanted to look at for Alphabet is the return on invested capital. And this is especially important right now because Alphabet is increasing how much it's spending in capital expenditures. It told investors it would spend roughly $80 billion in 2025. And as the year has progressed, it's increased those estimates, and it's now above $90 billion it will likely spend in 2025 on capital expenditure. And the company told investors that it will likely increase by billions more next year, so likely over $100 billion in spending on CapEx in 2026, and probably 2027 will be another big year of capital expenditure as it's building out the infrastructure of data centers based on GPUs. The previous generation data centers were based on CPUs, and these next generation data centers are so much more valuable in terms of the total cost of ownership compared to the previous generation that it's a no-brainer for Alphabet to invest, even if demand to sell the service is not as strong as it is right now. The company can use this computing capacity internally to improve its own operations across its business products. So a return on invested capital of roughly 25% on average over the previous decade and over 33% over the previous 5 years demonstrates that Alphabet's management team is effective at allocating capital. This is well above the company's weighted average cost of capital, which is the threshold, which is the hurdle rate at which beyond that point a company is adding shareholder value. So the next thing I wanted to evaluate is the company's operating cash flow to sales ratio. And this too has been solid over the previous decade and improving in recent years ever since in late 2022. If you remember, Alphabet undertook a major restructuring where it let go of thousands of people and paid more attention to costs. Those strategic initiatives have paid off handsomely as its cash flow from operations to sales ratio jumped from 32% in 2022 up to 39% in the most recent trailing 12-month period. So now let's look at valuation. And by the way, I'm getting all these charts from fiscal.ai, my preferred data provider. There's a link in the description. If you use that link, you'll get 15% off their services. Alphabet is trading at a forward PE of 30, which in my opinion is fairly valued for a business that's likely to grow revenue at double digits with the cash flow to sales ratio approaching 40% and an ROIC that's averaged 30% in recent years. But I also like to look at valuation on my own proprietary discounted cash flow model, and I updated this model today, and Alphabet's intrinsic value per share increased to $313. That's what I believe is a fair value for this stock. And the current market price is $321. So it looks fairly valued on this metric as well. So whether I look at it on my proprietary DCF or on the forward PE multiple, Alphabet stock looks fairly valued. And what I typically say about fairly valued companies is if it's a great business, and Alphabet is a great business. It's one of the best in the world, in my opinion. It's a Hall of Fame business. And for an investor, if you can get a Hall of Fame business at a fair value, I think it's a great deal. And so to update my recommendation for Alphabet, I will reiterate my buy rating for the stock today, December 3rd, 2025. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.